Consider a quiet moment in a late 2025 boardroom. Markets are calm, stocks hover near record levels, employment looks stable. Nothing feels urgent. And that is precisely the problem. Because on the table in that room is not a headline or a press release. It is a technical publication written for central bankers, regulators, and sovereign risk managers. It is not meant for the public. It exists to coordinate expectations among those who quietly manage the financial system. Its latest outlook for 2026 does not describe a normal recession. It describes something more basic: the return of fiscal gravity. In plain terms, the math no longer works. This is not a stock market story. Stocks are a distraction. The stress begins in the bond market, specifically in U.S. government debt. The United States now needs to sell close to $2 trillion in new treasury bonds every year just to operate. No to expand the economy or invest in the future. Simply to roll existing obligations forward, sure. For decades, that supply had reliable buyers: foreign governments, central banks, and the Federal Reserve itself. These buyers were largely insensitive to price. Those buyers are stepping back. China has reduced its treasury holdings. The Federal Reserve is no longer a net buyer. That leaves private investors who do not absorb unlimited debt without demanding compensation. That compensation is higher interest rates. If yields rise and remain elevated, the United States must refinance tens of trillions of dollars of existing debt at those higher rates. Interest payments already exceed military spending. Continue along this path, and interest begins to crowd out nearly every other federal function. At that point, the government is no longer governing. It is servicing its own balance sheet. This is why bond markets matter more than elections, earnings, or headlines. A loss of confidence in sovereign debt is the most dangerous financial event a modern economy can face. Once bond investors demand higher yields, reassurance no longer works. The math takes over. At the same time, the support holding up equity markets is becoming fragile. A disproportionate share of recent growth has come from capital spending tied to artificial intelligence. Companies are investing hundreds of billions in chips, data centers, and infrastructure. That spending shows up as GDP growth and supports employment. But the imbalance is growing. For many firms, revenue is lagging far behind cost. Efficiency gains are slower than expected. Profit margins are tightening. By 2026, investors begin asking a different question. Not what AI could do, but what it is earning. Capital markets eventually shift from funding potential to demanding cash flow. When that shift happens, spending slows sharply. Because AI investment has become one of the dominant contributors to marginal growth, a slowdown does not gently decelerate the economy. It hits a wall. There is also a second-order effect. Retirement accounts and pensions are heavily concentrated in a small group of technology companies. A valuation reset makes households feel poorer. Spending declines. A negative feedback loop forms. Economic strain rarely arrives alone. The year 2026 marks the nation's 250th anniversary. The risk outlined in elite forecasts is not unity, but fracture. Political paralysis and declining trust weaken the foundation of the dollar. Currencies are backed by confidence. As domestic instability rises, global capital seeks alternatives. Central banks are already preparing. Gold accumulation is at multi-decade highs. New settlement systems are quietly being built. These are not ideological moves. They are hedges. Internal instability accelerates external diversification. This raises an uncomfortable question. Is such a synchronized crisis merely an accident, or a transition being managed rather than avoided? Policy language is revealing. Officials increasingly speak of managing stress, not preventing it. Of maintaining order, not preserving the existing structure. The current debt system is mathematically unsustainable. A crisis provides political cover for structural change. One proposed response is the introduction of central bank digital currencies. Presented as stabilizing tools, they promise safety and efficiency. They also introduce programmability and control. Banking consolidation becomes not a side effect, but a feature. Yet the most immediate risk does not sit with central banks. It sits in private credit. Over the past decade, trillions of dollars in loans have been issued by private funds operating outside traditional regulation. These loans are often floating rate and illiquid. In a high-rate, slowing growth environment, defaults rise quickly. There is no public backstop here. When losses surface, funds are forced to sell assets to meet obligations. Those sales spread outward into real estate, pensions, and global markets. This is how localized stress becomes systemic contagion. History offers parallels. Periods like the late 1920s or the 1970s, when financial excess met political failure. Each time, the result was a painful recalibration of value and power. If 2026 marks a similar inflection point, the rules of the last decade invert. Passive exposure no longer protects. Counterparty promises weaken. Resilience shifts from maximizing returns to preserving durability. This is not speculation. It is visible in institutional behavior. The warning has been delivered quietly. The rest is a matter of preparation.